If you were a person in Canada who had a variable rate mortgage, a home equity line of credit, or you were hoping to take them with your new home purchase, you got some disappointing news from the Bank of Canada today. They did not cut their key interest rate, which directly affects the variable rate and home equity lines of credit. This does not affect fixed rates. Fixed rates are connected to the bond market. So today's news is strictly for folks with variable rates. To get into it, let's go to this story from the Financial Post. Bank of Canada holds interest rate at 2.75% again as uncertainty remains high. The Bank of Canada decided to hold its interest rate on Wednesday, today, saying uncertainty remains high and it will continue to assess the impact of U.S. tariffs on the economy. The Canadian economy is softer but not sharply weaker, and we've seen some firmness in recent inflation data, said Bank of Canada Governor Tim Macklem in prepared remarks in Ottawa. Against this backdrop, we decided to hold the policy rate unchanged as we continue to gain more information on U.S. trade policy and its impact. Macklem added that the trade conflict with the United States remains the biggest headwind facing the Canadian economy. On Wednesday, U.S. President Donald Trump doubled tariffs on steel and aluminum to 50%. Duties on Canadian autos, goods, and energy remain in place, though many goods are exempted under the Canada-United States-Mexico Agreement. Economic and security negotiations between the U.S. administration and the Canadian government are ongoing. Macklem singled out inflation in the decision, which in April came in hotter than expected for core measures, which the central bank prefers to look at when making its monetary policy decisions. This is from Macklem. There is some unusual volatility in inflation, but the measures suggest underlying inflation could be firmer than we thought. Higher core inflation can be partly attributed to higher good prices, including food, and may reflect effects of trade disruption. The central bank said it will continue to monitor how inflationary pressures are evolving, as recent survey data from the bank indicated businesses intend to pass on the costs of tariffs onto consumers. Growth in the first quarter was also above the central bank's expectations, with gross domestic product rising 2.2%. Growth at the beginning of the year was boosted by a surge in Canadian exports to the United States as businesses race to beat Trump's tariffs. The central bank expects growth to be considerably weaker in the second quarter. Exports and inventories were strong, but the final domestic demand was roughly flat, said Macklem. Consumer spending slowed from a very strong fourth quarter pace, but continued to grow despite a sharp drop in consumer confidence. The labor market, I think this is probably the most important part of this report, the labor market deteriorated in April, with the unemployment rate climbing to 6.9%. This was due to a drop in employment in trade-intensive sectors such as manufacturing. So far, employment has held up across sectors that are less exposed to trade, said Macklem, but businesses are generally telling us that they plan to scale back hiring. While the governor said there was a clear consensus to hold the policy rate Wednesday, there was a diversity of views among the 7 members of the Governing Council for the path forward for interest rates. Now, whenever we get stories like this, the Bank of Canada echoes 3 main talking points. They're saying, what is the economy doing? What is inflation doing? And how is the consumer doing? And so as you're kind of reading through these, you can kind of see that those 3 things will be the things that the Bank of Canada will look at before they decide to pull their financial levers to either increase the Bank of Canada's key interest rate or lower that key interest rate. And so from this report, we can glean, I think the most importantly, that the labor market is very weak, meaning the consumer is not doing well. 7% unemployment is not good, especially in a sector that actually might see a lot more restriction or contraction in that field. So that's likely going to get better. And you heard that quote that businesses are scaling back hiring. This is starting to be kind of the echoes of what we're heading into in the future here in Canada of potential recession. Now, some other factors, we saw the inflation stay flat but firmer than they would like. We likely saw a little reduction in the inflation due to the carbon tax being taken off. Now, groceries, gas are a lot cheaper for consumers, and so this helps that affordability piece. And lastly, on the economic front, it sounds like the economy is performing steady. We're doing fairly well. And so I think, the two outweigh the consumer, but I don't think that's going to last for very long. I think as we kind of go into the latter part of this year, I would guess the Bank of Canada is going to have to start reducing rates because of this consumer crunch that we're also feeling. You're also seeing a lot of folks who had low interest rates in 2020, 2021, who are renewing into today's higher rates. No, they're not the 5 or the 6% that we were seeing last year, but they are higher mortgage rates, and sometimes their payments are going way up for their household debt. So let me know what you think. What is the Bank of Canada going to do in the rest of 2025? Our next meeting is coming up on July 30th, so we have just about 60 days to kind of sit and see what the Bank of Canada does.